Hello everyone, welcome back. I got some really good ones for you today. So the big headline, action in the debt market, action in the bond market over the last few trading days. Crazy. We talked about in earlier videos how rising yields, rising rates, and a rising dollar can put a lot of downward pressure on risk assets like the NASDAQ, Bitcoin, or real estate. Well, you're seeing that mechanism at play right now. It's not so much the 10-year rising as it is how quickly it's rising. These 10, 15, 20 basis point moves higher in the 10-year yield, mechanically what you're seeing is a ton of money leaving the bond market. And all that money leaving the bond market is scaring the stock market and all other markets out to the end of the risk curve, like Beanie Babies, Squishmallows, Bitcoins, whatever. So rising 10-year yield, structural changes in the debt market over the last 72 hours have really sent shockwaves and reverberations in all directions. I don't care if you're trading pencil erasers or long underwear, your asset class is being priced based on what action in the debt market. So that's where we got to turn our attention. The whales and big players at the table like Druckenmiller and Gunlock, I'm going to try to get into their head. I can't, but I do follow these guys, and maybe we can try to get into their head and understand what they're seeing. I think that's a good way to frame everything. So not only do they not like rising interest rates and yields and a rising dollar just on its own, but they especially don't like it against the backdrop of such high inflation, a Fed prime rate that's way too low compared to inflation, an uncertain growth regime, and a Fed that's trying to tighten into all that. So you have a situation now where ideally the Fed would be in position to actually cut rates if things got weird, but they can't cut anymore. They're way too low for way too long. So now they have to start coming up. So that right there, elites don't like to see rising yields, rising rates. It really starts to jank up risk asset prices and create a lot of volatility. And then it's against the backdrop of high inflation and uncertain growth regime and a Fed that really needs to get that interest rate up there because they're quote unquote falling behind the curve. Even though they built the curve, they are the curve. They built the people in the room. They put themselves in the corner. You know what I mean? So if they're behind the curve, they are the curve. They put themselves there. They're setting the tone for everything. So it's not like the Fed is really being bullied around too much. They built this environment, but Fed's under a lot of pressure to raise interest rates, especially on Wednesday. Markets putting a lot of pressure on the Fed to raise interest rates as much as 1% on Wednesday, which, hey, they're getting there with hawkish status, okay? I look at Yellen and Powell as doves and baby doves and the doviest doves to ever dove, but they're hawkish rhetoric, and if they were to start raising interest rates 1% a meeting, hey, that's some Volcker-worthy status right there. So Fed's becoming more hawkish. Market wants to see a vote of confidence that the Fed's going to do something about inflation. I'm looking at 50 to 75 basis point hike on Wednesday. If the Fed can do that, get away with that hike, and promise more hikes if inflation gets out of control, maybe the markets will really stabilize here. So just because the Fed's about to raise interest rates again on Wednesday doesn't mean I would want to go chasing that and go short on Fed day. You know what I mean? The algos and the high frequency traders are just going to eat your lunch, and Fed day might actually end up being the bottom for risk assets, at least short term. So, hey, not buy or sell recommendation. I don't know what's going to happen, but just kind of how I see it playing out. Markets want the Fed to raise 50, 75 basis points. Fed will do it. And maybe by July or August, these rate hikes, demand destruction, falling demand will bring prices down. And then if wages can keep going up to meet that, and then now that the economy and financial system are kind of coming to parity with one another, hey, maybe we can even take some of these 14 rate hikes that are already baked in off the table in fall and actually see asset prices like the NASDAQ move higher. So that's kind of like your bullish case, okay? So if you're a bull for Wednesday, and you're a bull on risk assets, like you're a Bitcoiner or a gold bug or a NASDAQ guy or a real estate guy, you want to see a vote of confidence from the markets to the Fed on Wednesday of that 75, 50 basis point hike, whatever it ends up being. You want to see inflation kind of get under control. You want to see the economy be able to continue to stand on its own feet and maybe even have wages come up a little bit if companies can handle that? I hope so. People really need a pay raise. It's disgusting. And maybe we can have an environment where things stabilize and the Fed actually takes some of these 14 rate hikes off the table. Or we end up in an environment where rates and yields keep going higher in an uncontrolled fashion and the Fed actually comes back. Talked about that in a couple of videos ago, but it's hard to say what the Fed's going to do, right? If the Fed were to start cutting interest rates right now from only 75 basis points on the prime rate, that would destroy the dollar. Bottom would fall out of the dollar. Bitcoin would probably go to 100 grand, but it would be a really nasty scenario, and houses would be crashing up in the process. It would be disgusting. It'd be a dollar collapse essentially. So the Fed can't cut rates, which is scary, even if the economy slows down from here. So Fed's tightening into an uncertain growth regime and high inflation, and it's just kind of freaking people out. So it's kind of funneling people into different camps. So if you're a dollar bull right now, you're looking at higher rates, higher yields and rates staying structurally higher going forward. You want to hold on to your dollars. You want to keep your dollars under the mattress. You know monetary conditions are going to tighten. You know people are going to get hit with margin calls. You know you're going to see deleveraging in the system because a lot of these companies are dependent on low interest rate policy to exist. So if you're a dollar bull, you're waiting on a lot of these companies to become insolvent if rates and yields continue to rise, and you're waiting for mortgage rates to rise and push home prices down. You're waiting for basically the dollar to continue catching this massive bid. I'm not a dollar bull, but I see the case for that. Okay, so if you're wearing the dollar suspenders and you're the cash is king during a crash kind of guy, hey, there's totally an argument to be made for that, and you're in pretty good company right now. And we will talk about the dollar later on this week. Like, just because I'm not a dollar guy, it has world reserve currency status, it has petrodollar status, taxes have to be paid in dollars. The Treasury is pretty good record of solvency. They have a monopoly on these physical force. They keep the trade lanes open. Another fun fact about dollars, there's always more demand for dollars than there is supply, because as we funnel dollars down the fiat global Ponzi, they're all due back up plus interest. So there's always a mad scramble in the Ponzi for more dollars than actually exist, and that creates a lot of artificial demand for dollars. It's also like what's used in global trade. My point is the dollar has a lot going for it, even though I'm not a big dollar fan, and we'll talk about that later on in the week. So hey, if you're one of those cash under the mattress kind of guys, we'll have that discussion later on this week. And like I said, you're in good company. I'm not flipping though. I love high growth tech here, so I like the NASDAQ. I like Bitcoin at like 22, 23. To me, that's like a fire sale price. I was in Bitcoin when the bank showed up in fall of 2020, and the banks and institutions showed up around the $20,000 Bitcoin mark. So we're back there. So my reasoning is, short of JP Morgan, Fidelity, Morgan Stanley, all these institutions that showed up into the crypto space, my view is, short of them leaving, packing up their stuff, leaving the building and never coming back, I think Bitcoin's crashed about as far as it could go. But I could totally be wrong on that. Not a buy or sell recommendation. Bitcoin is totally not for everybody. And let's say that 10-year yield keeps rising and it goes from like 3.25%, 3.5% to 5.5%. Well, my back of the envelope math says that if the 10-year yield hits 5.5%, boom, Bitcoin's 9 grand, Bitcoin's 8 grand. The Dow Jones is below 25,000. Median home prices fall back to 250, 300,000. So I could totally see the situation where the 10-year yield keeps rising, and if that 10-year yield rises all the way up to 5.5%, look out below for all your favorite risk assets. So hey, totally a case to be made for like sub 10,000 Bitcoin, but I'm just saying 20,000 is the point where the bank showed up. I don't see them ever leaving the building. I think this is about as bad as it gets. I'm loving these fire sale prices. Just my 2 cents. So we kind of talked about action in the debt market. Talked about the Fed on Wednesday, expect that 50 to 75 basis point hike, and then rhetoric about getting inflation under control. So we talked about the debt market and the Fed. We've talked about what that could imply for risk assets. We've talked about the dollar bulls, and we've talked a little bit about Bitcoin. I'm loving Bitcoin here at 22, 23. I'm loving the alts here too. It ultimately is rates and yields that put Bitcoin down in the dumpster. So Celsius and Luna obviously aren't helping the situation, but it's ultimately action in the debt market that's going to decide the fate of Bitcoin, in my opinion, going forward. So keep an eye on the debt market, even if you're a Bitcoiner or an oil guy or whatever. It's all the debt market right now. So we talked about the debt market. We talked about the Fed, expectations for the Fed, the dollar bull camp. Let's talk about the dollar bear camp. So the Fed, if rates and yields do keep skyrocketing and that keeps forcing the S&P 500 to puke up 10-15% at a time, if the Fed comes back to save the S&P 500, which they have a precedent of doing in the past, then I expect immediately a reversal in risk assets to the upside and a dollar collapse. So the Fed's kind of at a bit of a crossroads. It's like, are you going to raise interest rates and cull the zombie S&P 500 companies and force everyone into liquidation and margin calls? Or are you going to lower the interest rate even further with inflation already being as bad as it is and just bite the bullet on collapsing the dollar, and then we'll watch Bitcoin go up to 100 grand and houses crash up to 1 million and Dow Jones crashes up to 50,000, almost all like in a pretty short period of time. So that'd be your dollar bear case. And you might be like, okay, well, if you're a Bitcoin or a gold bug NASDAQ guy, is that what you're betting on? You're betting on the Fed to come back and then to just absolutely destroy the dollar? I mean, I could see them doing that because they do stuff like that. They throw the kitchen sink and the dollar at the markets to protect them and inflate them all, regularly. So I wouldn't totally remove that as a possibility. But also, I don't need that to happen for Bitcoin, gold, risk assets to start doing well again. And so what's my tentatively bullish stable case going forward? Well, you're going to look for the Fed to get a vote of confidence on Wednesday, do their 50 basis point or 75 basis point hike, promise more in July if things get worse, and then you're hoping that in July, demand destruction, falling demand, falling prices, rising interest rates kind of stops inflation. And then you're also hoping wages and the real economy and people kind of catch up to this inflation, and then we see a little stability. And then you're hoping maybe tentatively, now that the market's baked in 14 rate hikes, and maybe they do some aggressive ones over the summer, maybe we'll draw down from like 14 to 9 and we won't need that many rate hikes. And then you could see a situation where all your favorite risk assets just start to step back up. So that would actually be kind of a tentatively bullish, stable, hey, it's all good in the hood scenario. But that camp is shrinking. The deflationist camp is growing. The dollar bull camp is growing. There's a growing belief that yields and rates are going to be structurally much higher going forward. Like I said, I'm not necessarily in that camp, but if that's the case, start the timer on a lot of people going bankrupt and a lot of deflation, disinflation, rising dollar, a lot of craziness. So that's kind of your freaked out deflationist view, but hey, they could totally be right too. Like, do your thing, do what you think is best. This is just kind of information, and I'm just kind of trying to frame things as best as I can so that you can, add it to your toolbox. That's kind of all I got for right now. We'll reconvene as things progress. We'll have that talk about the dollar later on in the week. And in the meantime, long and strong, high growth tech, gold, oil, Bitcoin, like I'm about that life. I love these fire sale prices, but hey, that's just me. And if you want to wear your dollar suspenders and, put dollars under the mattress and just be hanging out with King Dollar, hey, that's your prerogative. And we'll discuss that later this week. Till next time.